Hello, good afternoon, everybody. Thank you so much for joining us on this Wednesday afternoon. As we give everybody a few minutes just to join, I'll play a short video in the background. Wonderful, wonderful. So, good afternoon, everybody. Thank you so much for joining us again for our Glassdoor webinar. My name is Laura Nieves. I am Head of Investor Relations here at Astor. We're very excited to have you with us. This is an exciting session this month. We're going to do a deep dive into powerful tax strategies that can help you optimize your investment returns. At Astor, we're committed to preserving and growing our investors' wealth. As Forbes aptly put it, the goal of long-term investing is to preserve wealth through the accumulation of tangible tax-advantaged assets. This resonates deeply with our mission here at Astor, as we're not only focused on identifying high-quality real estate investments, but on leveraging every strategy possible to protect and enhance the value of these investments, especially through tax efficiencies. So that's why I'm very, very impressed by our turnout today, but not surprised, as our topic is cost segregation and bonus depreciation. And we're going to go into and share with you why it is so valuable. These strategies allow investors to benefit from immediate tax savings, making it easier for you to accumulate wealth and maintain cash flow. You're going to hear firsthand from our guests today on how to apply these approaches to maximize your returns and achieve sustained financial growth. So a little bit before we dive into it about Astor Realty Capital. Leading Astor Realty Capital is our CEO and founder, Joe Berko. He has built our firm to a $3.1 billion portfolio spanning 12 major US markets. Joe has 25 plus years in commercial real estate finance and investment banking, and he has shaped Astor's mission, and we have successfully delivered consistent above average returns whilst prioritizing ethical, high quality investments. Joe's achievements over the years have earned him national recognition and awards like CoStar's Power Broker and Globe Street's New York Signature Broker. And also today from Astor, we are joined by Andrew Milbank, our CIO. Andrew is instrumental in shaping our investment strategy. Andrew's expertise has allowed us to capitalize on strategic opportunities and stay true to our commitment to high quality, short duration investments with significant upside potential. So now we are very, very lucky and privileged today to feature two guest speakers who will give us deep insights into how these tax strategies work. Today we have Len Berkowitz. Len brings over 18 years of tax experience. He specializes in tax efficient structuring for high net worth individuals and corporations. He has a proven track record of meaningful savings for clients through practical tax advice and has been a sought after speaker at many very well-known professional tax conferences. And we also have our wonderful long-term partner, Kevin Chow. Kevin is the managing partner of Cornum Capital. He has extensive experience as a real estate investor and operator himself. Kevin has managed over 2,000 units across the US, and he has raised substantial capital from high net worth investors, family offices, and funds. So together, we are going to provide you, our audience today, actionable insights into how cost segregation and bonus depreciation can help you build and preserve your wealth in today's dynamic market. As always, we encourage a collaborative session. Please use the Q&A feature and the chat during the webinar, and we'll make sure that we will get those questions answered for you. So in that, let me pass it over to Joe and Andrew.
Perfect. Thank you, Laura. So welcome everybody. We're very excited to go over this today. Laura, if you can bring up just the presentation, just the start on Astor, right? Most of you probably know us at this point from our development experience, right? A lot of what we have done is LP equity and preferred equity into development projects with a majority focus in New York and Florida. Happy to say that is going very well for us. We have, as Laura mentioned, about 3,600 units, about 4.5 million square feet. And it's been an additional focus for us, I'd say, over the past 12 to 18 months, doing a good bit of research and partnering with individuals such as Len and Kevin that can help us to shape the more tax efficient strategies. Some of you in our most recent projects will be aware that we've been able to now offer different tax structures, both for US-based and foreign investors that are much more advantaged than opportunities that we have looked at in the past. And the opportunity that we're looking at right now, which is kind of what led a bit to this webinar today, is the concept of a cost segregation study and accelerated depreciation, and how that can benefit you as the investor to potentially offset other passive income that you may have, while also still benefiting from the positive aspects of a deal itself, right? So one of the deals that we're looking at right now is in Miami. It is a brand new asset, just finished in 2022, recently stabilized, 260 apartments with 4 retail units. Astor is considering an $8 million investment in this property, looking at roughly 19 to 21% net returns to you, the investor, over a 5-year period. One of the reasons that we find this so compelling from a risk standpoint is it's an existing building that is cash flow positive today, with cash flow positive leverage today. But the partner that we're working with on this has substantially improved the returns using a tax abatement called the Live Local Act, which they were able to implement post-contract, that delivers a ton of value to us, right? That is separate on its own, a good deal, right? We like this deal because of those factors on their own. The bonus here, right, the additional potential benefits to you, the investor, from a cost segregation study, which leads to the accelerated depreciation, is the fact that we're able to deliver those tax benefits, which are roughly $92,600 in additional depreciation that you could use to offset qualifying passive income, which Len is about to jump into. That's roughly, right? And I'll always use that disclaimer, right? Astor's not a tax advisor. Neither is Len, neither is Kevin. There's always something that you'll work with your own tax advisor to go through. Roughly $30 to $40,000 of additional net tax savings over a 5-year period, right? So when we're looking at the investments themselves, we want them to stand on their own, plus look at any potential benefit. For those of you that are familiar with some of our prior investments at some preferred equity deals in Brooklyn, the deals themselves stood on their own, plus we were able to deliver a personal guarantee, right? So, looking at it from a risk standpoint, which is, my day in, day out, that's where we see a lot of potential benefit. So,
Something to add, Drew. Something to add to that introduction. Hello, everyone. I think it's extremely important to point out that over the last 5 years, 7 years, 10 years, maybe, the reason we have not jumped into existing real estate deals is because the return were suboptimal for us and ultimately for our investors. That's a space that we found to be overly saturated, what we call sometimes the low-hanging fruit. It doesn't take too much creativity to see a possibility to enter into an existing deal. It's sometimes referred to as core deals. They have a place, obviously, in real estate, and some of the larger funds, institutional funds, love investing in those because it gives them that steady 4 or 5%, 6%, if you will, steady income. And sort of like it's very easy to fluctuate. So if your cost of capital in an institutional level is very low, right? A couple of 100 basis points over whatever low treasuries, then you're okay to sort of like create this. If you're an insurance company, it's kind of like perfect. Astor haven't gone into those deals because those deals were never juicy enough. This is one of those rare opportunities that are also a sign of the time. This is a deal. We're not in contract on it yet. We're evaluating it. But we decided to bring it forth to this conversation just to take the level of interest that we have from our investors. And finally, very rare, we look through a lot of deals, but very rare, we find a deal that is a Class A, right? Sizable deal, 2022 build, so it's like 2 years old, not even. And, it has all the elements, but it also brings us this extra, right? This extra oomph, if you will. So not only we're able to deliver a 19% return to our investors net, we're also able to bring you something other, which is the depreciation on top of it. So I want to say this team in general and global, right? The entire Astor team, we're done. I think some of our deals have been, if you don't mind me saying it, have been exceptional in the terms of returns we were able to achieve. They're really outsized returns. Those of you participating in the preferred returns that we're creating, we've created some pretty interesting structures that really are not seen in the market. But at the same time, we all love the infection to those deals. We've also created a good amount of taxable income. So here's an opportunity, and I think we're going to start implementing at least once a year. We're going to try very hard to find a deal that we can create a tremendous income for our investors and then create some sort of a way to offset this income. So this is really the thinking behind this. Everything else Andrew mentioned, obviously, it hits the spot. I mean, we're talking about we reduce risk because there's no construction risk, right? The building is, fairly stabilized at 93+% at this stage. So we know the rents, we know the markets, we know all those different things. The asset is established. So everything is there, but we have this extra. This is the area that we're interested. And so together, I think we're going to learn through with the two professionals that we have with us. So without further ado, maybe jump right in, Andrew.
Yeah, so as Laura mentioned, we're very privileged to have Len with us. Len has more than 18 years of tax experience, and his company focuses specifically on cost segregation studies and bonus depreciation. and how we can use that from asset to asset. So, Len, please take it away.
Thanks, guys, and thanks for that intro. I think you've basically kind of stolen my whole presentation, guys. You talked about all the benefits of cost seg. There's not much for me to discuss anymore. All right, but here's talking about Andrew and Joe kind of talked about cost segregation and what the benefits are, but I think it's important to take a step back and just understand what cost segregation is. The goal of this is not to make you guys experts in cost seg overnight. The goal is just to give you kind of an indication of what cost seg is and what we do, and then we can talk about what the benefits are generally, and maybe with a little more specificity about this property, just because it's standing here in front of us. So what is cost segregation, right? So cost seg is the practice of identifying components that are contained within a piece of property and allocating or segregating their costs, right? So what do? Right, we go down to a building. We have engineers. They take a tour of the building and they start writing things down. They write down all the personal property that exists in the building. We create a report that's 50, 60 pages long that specifies the assets that contain within a building. And many of those assets that are contained within a building qualify for quicker depreciation periods than normal, meaning a normal building like this depreciates over 27 and a half years. So simply stated, if you buy a building for $100 million, you depreciate it over 27 and a half years, and you get effectively equal depreciation each year. With cost seg, we identify assets that exist within the building that are eligible for shorter depreciation periods. All right. So, and we do that through this process that's called the cost segregation study. Now, a cost segregation study has many, many elements that are required under the IRS. The IRS has a 200-page guide called the Audit Technique Guide on how to undertake a cost seg study, right? So we have to meet many elements that exist within this guide in order for the study to pass muster with the IRS. So by doing this, what are the benefits of the cost segregation study? The benefits of the cost segregation study are effectively accelerating depreciation to 5 and 15 years, right? So we are able to accelerate the depreciation that's normally 27 and a half years and take a portion of the building and allocate that portion of the building to what's called personal property, which depreciates over 5 years, and land improvements, which depreciate over 15 years, and we're able to accelerate it over that period. This gives us the ability to obviously front load that deduction. In certain cases, we can catch up on depreciation if we don't do it in the first year. We can minimize taxes upon a sale. So this gives us a lot of flexibility in when we're looking at an asset and we're trying to determine what the tax benefits are of acquiring this asset outside of the just general benefits of acquiring the asset, right? The financial, right? The financial benefits that Andrew and Joe are obviously very focused on, the return, right? This is able to kind of enhance that return, and you're able to kind of realize an additional tax benefit by doing so. Now, one of the things that has become why cost seg has kind of exploded in the last 6-7 years is the concept of bonus depreciation. Bonus depreciation was something that was introduced in 2017. I'm going to get back to this in a minute, but I want to talk about bonus depreciation. Bonus depreciation was something that was introduced in 2017, and it was brand new for used assets. Let me explain. What happened up until 2017, or the middle of 2017, was there was a concept of bonus depreciation, but bonus depreciation only applied to assets that were newly placed in service, which means it needed to be new construction. Anything that was not new construction was not eligible for bonus depreciation. The bonus depreciation that was introduced in 2017 now included assets that were placed in service for the first time by the taxpayer, which means any asset that was acquired by a taxpayer was now eligible potentially for bonus depreciation. That bonus depreciation, though, can only be identified through a cost seg study because your building itself, the building components that are the 27.5-year asset, that's not available. That's not eligible for bonus depreciation. Only personal property and land improvements. So in order to identify what assets are eligible for what's called bonus depreciation, you had to do a cost seg study. This was, cost seg had existed since, the mid 90s, really, but this really attracted a renewed interest in cost seg because people were able to front load so much of the depreciation into year one because there was 100% bonus depreciation from from mid 2017 through 2022. Now, once the problem was that the way they implemented the Tax Act in 2017, there were certain sunset provisions, and one of them was the bonus depreciation. So the bonus depreciation would sunset in 2027, and there was a declining balance each year. So through 2022, there was 100% bonus depreciation, 2023, 80%, and 2024, the year that we're talking about now, is a 60%, which means anything we identify in the cost seg study as a 5-year or 15-year asset, 60% of that is eligible for bonus depreciation in year one. So let's go back here and just talk about a general sample of cost seg, of what it does, and then we'll get a little more specific in our current investment. So in this example, we have a building, taxpayer acquires a building for $4.75 million. This example is a little bit of an older example. It's a 39-year asset. Like the asset that we're talking about today is multifamily, which is 27.5 years, but retail and industrial and commercial, they depreciate over 39 years. So in a normal case, a 39-year depreciation, after 5 years, the taxpayer will accumulate $603,900 of depreciation. However, if we undertake a cost seg study, we're able to accelerate an additional $476,000 of depreciation. That results into a 5-year tax savings of $190,000. All right, so the cost seg study in this case accelerates almost $500,000 of depreciation. That's very, very beneficial. Why is that beneficial? That's beneficial because of the concept of the time value of money, right? I'd rather have $1 in my pocket today than in 5, 6, 7, 30 years from now, right? So cost seg, right, the real benefit of cost seg is the time value of money of accelerating that deduction today, which is why the bonus depreciation is so much more valuable. Because the more I can accelerate today, the more depreciation I have up front to use. Now, let's fast forward to our current deal. All right. So we've put together a little bit of a very, very kind of brief or summarized view of this deal. The purchase price here is based on the information we've received. Obviously, these numbers can change somewhat, but let's just use the numbers that we have here. So the number that we have here is $95 million. Now there's $11 million allocation to land. All right, so land is not depreciable. So that is what it is. And we have an $84 million allocation to the building. Of that $84 million allocation to the building, we're able to identify about $25 million of 5 and 15-year property. That 5 and 15-year property is eligible to be accelerated. 60% of that is going to be accelerated in the year 2024, which means this here we took that out. Okay.
Yeah, apologies, Len. We
you condensed it a little here,
bit.
and all right, let me see if I can pull that up. I wanted to do the year 1 versus the year 5, and I see now that the year 1 was removed from this. So give me a second. I apologize, guys, but I do want to compare the year 1 to the year 5. So give me a second. Let me just pull this up on my screen here, and I'll do it. I apologize for this.
No problem. That's mine. You had a very nice chart, but I wanted to make sure it was big enough that folks could see it on the screen.
That's fine. So okay. So in our year 1, the reclassification results in depreciation of the first 5 years of the first year. The first year, that's a mistake. The first year of additional depreciation is $16 million, right? $16.870 million is our additional depreciation over the first year of the investment. So with this investment, we're accelerating almost $17 million of depreciation. Over the 5-year hold, we're going to have $33 million almost of depreciation. Which means when we look at this investment, the total equity investment here is $35.5 million. That 92% of that you will get back as a depreciation deduction. So if you think about it, if someone invests $100,000 of equity in this deal, they'll get a $48,600 return in depreciation in year one, and over the lifetime of the investment, there'll be a $92,600 return just on the depreciation. That's outside of any financial return that you guys are getting from just the economics of the deal. This is an additional depreciation benefit that you'll be receiving. Like Andrew said before, that 92,600 of depreciation results somewhere in $30,000 to $40,000 of actual tax benefit at a 40% tax rate. So these are very, very meaningful numbers when you're talking about making an investment in a project, right? Because if you're able to effectively recover 92% of your equity through depreciation, you're really enhancing your return. And
tremendously, Len. That's really, I mean, the essence of the structure. So I want to stay there for a moment. It's extremely important that we understand. I think maybe Andrew, go back to our example where we show potential investors what we're seeing and why we're doing all of this, right? Kind of like what's the purpose of this entire conversation?
Yes. Laura, you may need to go back, or Len, maybe you can go back. I think Len has the slide
yeah,
control.
where am I going back to? Sure.
The one that has like the potted plant on it.
Laura's got it.
Or the coin
Okay.
plant. Yeah.
Over there. And Kevin, feel free to chime in as well. So here's what we're trying to drive. Okay. So under a normal circumstance, we always like to give an example of 100,000, could be $1 million, could be 250. But in this particular case, round numbers, $100,000 invested over the course of 5 years. What we're projecting, okay, is cash flow, not quarterly, but over the course of 5 years, current cash flow of around just shy of 36,000, right? We're also expecting at the sale, the exit at the sale, to make an additional impact of $60-something thousand for a total of $95,000. Once you say, okay, I invested 100,000, I got back my 100,000 plus 95,000, basically made 95% cash on cash, okay, over the course of 5 years. Really nice, 90% a year, nothing to sneeze at. And my reduction, I've pretty much reduced a lot of the risk associated with market fluctuations, all that good stuff, because it's an existing asset. It's located also in Florida. It's in a place where we don't have a big tax impact because there's no city, there's no state. Good stuff. But here's what's on top of it, right? So not only I made myself a 19,000, if I qualify, and I'll have Kevin talk about what does it mean to qualify, but if I qualify, then there's this extra thing that I can get, another $90,000, $92,000. And that's what makes the thing a little bit more juicier. Kevin, you want to step in and talk to us a little bit about that?
Yeah, I mean, first I want to kind of jump in, kind of say one of the things that people don't realize with depreciation is that the depreciation can be used to offset other investments that you've made as well. So let's say this year, we're towards the end of the year, you've made a good bit of passive income on some investments, maybe other real estate investments you've made and all. You can use the depreciation on this investment, let's say the 48,000 on a $100,000 investment, and use that to offset that investment. Depreciation can be used between different investments, which is something a lot of investors don't realize, is that they believe that that depreciation only accounts for that particular asset. So when you receive,
if I sold stocks,
Yep.
and I made a gain, I can use it towards that, right? Instead of paying the
No, you
capital.
can't use it for stocks. So it's not, you can't use for capital gains on stocks, but you can use for other passive income. So it has to
Gotcha.
be other real estate. It could be a sale of a business that you are passively invested into and all.
Okay.
So it's just certain types of investments. But I mean, if you're a large real estate investor that's invested in a lot of things and you're having a good year, this is a great time to use an investment like that to offset it. Now, on top of that, the depreciation, which is shown on a K1. So if you guys seen a K1 in box 2, what we call real estate losses and gains, the depreciation will show up there as like a negative number, maybe negative 50,000. Okay. Now, if that depreciation is not used up this year, you don't lose it. It gets carried forward to the following year, next year. And so that's really important because over the next couple of years, the amount of depreciation you'll be able to receive on investment is going down. That bonus depreciation is going down from 60% this year versus 40% next year. What does that mean? If you made the same investment next year, you will receive less depreciation, even if the investment was entirely identical. And so what people will do is they want to essentially gather up this depreciation. They'll make an investment this year, get that 48,000, and then use it, have it ready to use for potentially some passive income gains next year. So gathering depreciation early on before you lose the ability to have it, because remember, by 2027, all that depreciation the ability to get depreciation is going to go away unless Congress changes anything. So it's really important because this year is going to it's going to go down after December 31st. The amount of depreciation that you can get on any kind of investment is going to be a lot less.
Okay, excellent. Thank you for that, Kevin. That's been very helpful. So, Len, back to you. Just trying to understand, and I love the mechanics, and I love how passionate you are about the mechanics of everything and how we get to the numbers that you're presenting here. This is $92,000, 600.
Yeah.
But give me a live example. And by the way, Kevin, you also didn't touch on who's eligible, what's eligible, all those things. But let's speak to Len first, and then I'm going to ask you about who's eligible and what does it mean to be eligible for something like that.
Sure. So, Joe, I'm not sure if you had a specific question there that you wanted me to address.
I do.
Yeah.
I said I see you're super passionate about the numbers and the accelerated depreciations, and you can take depreciation and sort of impact it much more sooner and much more quicker, and create a wonderful positive income. Wonderful impact for taxes. But what does it really mean? Like, can you give me an example? So I'm going to ask.
Oh yeah, sure.
Yeah.
Sure, of course. So and I think Kevin was kind of touching upon this with his comments, right? If someone invests in this deal and year one, they're getting 48 or 49 or 50,000, whatever, let's just use the number we have there, $48,000 of additional depreciation, right? Mm-hmm. That is a tax deduction that they can use to offset other passive income, right? So, some of your investors that are on this webinar here today may be passively invested in other assets, right? They may have, they may
most
own
are.
some rental.
Most are.
Right. So they may, right. They own rental properties.
We have good problems here. We have a lot of good problems here. Let's just call it that.
Right. So they own other rental properties. Maybe they're invested with some other syndicators, whatever the case may be. Maybe they have a sale of another property. I mean, there are a myriad of investments that throw off passive income that this deduction will be able to be used to offset against. And not having it would mean they'd be paying taxes at 40%.
Let me just simplify it even more, if you don't mind me saying it. So here I am. I'm a doctor. Not me, right? I'll never do it. I'm a doctor, and I made $1 million last year in income. And say that from the income that I made, let's assume that half of it, $500,000, came from my passive investments with Astor Realty Capital. Astor has done phenomenal for me. Been investing with them for years. So my clinic generated for me income through my work, my medical work of $500,000, and Astor has been instrumental in my income, created for me another $500,000 passively, right? And passive income for me. So let's assume whatever tax bracket. I'm just going to throw a number, and I'm going to say on the passive income, let's assume I need to pay $200,000, okay, in income. What would something like this, if I would invest according to $100,000 in this deal, how would that help me on my tax situation?
Yeah, so if you invested $100,000 in this deal, you'd get a deduction of 48,600 we talked about in depreciation in year one. And so instead of having $500,000 of passive income, I'd have 450, whatever that number is, right? 400, yeah, 450 we'll just round. 450 of income, and I've offset $50,000. But now, like, let's take it one step further, Joe.
Yeah.
Let's say we put $1 million into the deal, right? Let's say, the doctor had a good year, and doctor wants to, he loves you, Joe, and he loves what you've done for him. He says, listen, Joe, I love this deal. I'm giving you $1 million, right? Well, now he's getting $480,000. Effectively, what he's done is he's offset all his passive income. He won't be paying taxes on any of that passive income that he had from the other deals.
I see. So the doctor, our dear doctor, $500,000 that we've generated for him because we're so great at what we do. We've had a successful year. We've created for him $500,000 taxable income. If he were to invest $1 million and generate for him year one $482,000, that's essentially what's going to be reduced from his $500,000. So the taxes that he'll pay will only be on a small difference, maybe $80,000, right? Or something around those lines.
That's generally what would happen. Yes. Now, obviously, everyone's got to speak to their own tax advisor, make sure they're not limited in some way, shape, or form. There are complex rules as the depreciation and it flows up, and you want to make sure, but yes, generally that's the way it works.
Okay, so everyone's, I think we're on to something very cool over here. So let me ask you, Kevin, who qualifies? How do you get qualified for something like this?
Yeah, so anyone can really use it against passive income. So anyone that's investing here could use it. Now, there are certain investors who might be able to take a step further by being what's called a real estate professional status by the IRS. Now, there's a lot of rules for that and all. And again, as Len mentioned, speaking with tax advisor would be best. But if you get qualified as a real estate professional and all, and typically the way you would do it is you need to have at least 50% of your time spent as a real estate professional and all. It could be a real estate broker and at least 750 hours a year. Now, there's a lot of rules to it. Again, speak with tax advisor. But what some people have done is, let's say we use the example of the doctor. So one of within a family, perhaps the husband's the doctor, and the wife would take on a role of a real estate professional. Okay, so as long as within a married couple or spouse, one of them is considered a real estate professional, you would be able to, again, got to follow some of the rules, be able to use the depreciation against not just passive income anymore. You can use it against ordinary income, which becomes extremely valuable, especially if you're a very high income earner.
Beautiful.
Yeah,
That's an interesting strategy.
Yeah, just to elaborate on what Kevin's saying, he's 100% right. And that's kind of like the holy grail of depreciation and cost segregation is for real estate professionals. And Kevin's strategy the strategy that Kevin kind of mentioned regarding the husband and wife is definitely something that's employed. However, again, I would like to implore, if you plan on doing that, you must speak to a tax professional and you must make sure to be working with them, because that is one of those things that if all of a sudden somebody shows up on someone's tax return that now the wife's a real estate professional, those are one of those things that could get picked up, and you want to make sure you meet those qualifications. There's hours, there's all sorts of qualifications that the IRS sets up to do that, and it's all doable. but you really have to meet those requirements to do it. So if I was talking to someone recently who was very, very, it's actually, apropos. This person, he has a law firm. He has a very successful law practice, and he does a lot of real estate on the side, but he can't be a real estate professional because he has his law practice. And he called me recently, asked me, hey, what can we do? And we talked about the strategy of his wife becoming a real estate professional. And he actually wants to hire someone to kind of manage that process and audit it to make sure that it's really kind of above board and meets the requirements of the IRS. So yes, things like that can work, but I think Kevin would agree. You really want to make sure you're speaking to tax professionals to ensure that you're meeting all requirements.
So it absolutely has to be done the right way. But if it's done the right way, it's really very, very significant. Well, thank you very much, gents. I mean, that's been very helpful. Len, are you okay with the presentation? Can we skip into question and answers? Do you have anything to sum up on the presentation before we do?
I think I'm good. I'm happy to jump to questions and answers.
So we have a couple Q&A then. So if you don't mind. So Kevin, you mentioned we can save this depreciation for future years if we don't use it this year. Is there a limit to how many years that can be carried over?
No, it can be carried over indefinitely at all. So,
okay.
Yeah.
Beautiful. And this does not, this could be to either of you, this doesn't offset, active ordinary income from your standard like W-2 wages, correct? It's only passive income from an investor or if you're employed as a real estate professional.
Yes, that's correct.
Okay. All right. So I have, I guess, Len, maybe you can talk about the downside, if you will, but obviously there's strategies in the future to try to mitigate this recapture, right? So what do folks need to know about potential recapture of the bonus depreciation?
Sure. So recapture basically is that you can look at the cost seg and the accelerated depreciation almost like a interest-free loan from the government. All right, where the government's saying, hey, we're going to front load. You have the ability to front load this depreciation, but when you sell the property, all that depreciation that you took, we're going to recapture, and you're going to pay the ordinary income tax rates on that. Normally, in every deal, you have recapture, right? Whenever you sell a property, forgetting about cost seg, if you own a piece of property and it depreciates as it does, any investment property, and then you sell it, there's recapture. The normal recapture rate is 25%, right? So simple stated, I buy a property for 500K. I take 100,000 of depreciation, normal depreciation, and I sell it for $1 million. I have a $600,000 gain. $500,000 of that gain is capital gains tax rates, and 100K is 25% depreciation recapture. If I do cost seg and I offset another 100K with accelerated depreciation, that 100K is subject to gains at ordinary income tax rates. Now, there are a couple ways around this. One way is 1031ing. So if we ever sell the asset and we do a 1031, we don't pay the recapture typically. So that's the easy way around it. The other way is a little more consultative because there are differing views on how to calculate the recapture, particularly the longer you hold the asset, and how you allocate that capital gain. Not everyone will necessarily allocate the capital gain to the depreciation recapture. There are those that will take the view, and when they sell the asset, imagine I did a cost seg in 2024, and I hold the asset, a little more than my 5-year hold. Maybe I hold it 7 or 8 years. Now we're in 2033, whatever, 2032, and we sell the asset then. We took what was it? We took millions of $30 million of accelerated depreciation. That'd be a very large gain to be paying ordinary income tax rates on. There are those that have that we've worked with that will say, well, in the 7-8 years, many of those assets that we've in fact depreciated year 1 through 5, they don't really retain much value. The value in the larger asset is the building, and they may ascribe less of a value to those assets that were fully depreciated. Again, I'm not saying that everyone's going to do that. I'm not saying that your accountant subscribes to that theory. Your worst case, quote unquote, scenario is that you don't do a 1031, and now you're paying back that depreciation that you got the benefit of all those years later. So instead of paying capital gains tax on that amount, you're paying ordinary income. That's a little bit of a higher rate. But the people I've worked with in the past have typically either 1031 or have at least held it a long enough time where they felt comfortable, and their accountants and their tax advisors felt comfortable not allocating all of that gain to the recapture rate.
Right.
I don't know if
And
Kevin.
there's also kind of the standard saying, right? Money today is worth more than money tomorrow, right? So there's a lot of investors that are happy to kick the can down the road. If that means there's more money in their pocket today that they're either, spending on their lifestyle, or they're able to reinvest, right, to offset that in the future, right? So that's, the third solution, which is not a solution, but kind of a way of looking at it, perhaps, right?
I think there are some other ways that you might be able to kind of kick that can down the line is obviously if you make another investment that has some depreciation, you can use the depreciation off that new investment. You can also make investments in QOZ or qualified opportunity zones, which may be a way to also kick the can down the line. But I think the key thing that I always tell investors is what everyone's really discussed here, which is time value of money. And all, a dollar today is worth much more than a dollar 5 or 6 years down the line.
Right. Very, very interesting comments. Thank you for that. Qualified opportunity zones. We didn't think about that. That's going to be very interesting. And yes, going back to my earlier comments, I think that once a year, as I said, we're not the biggest fans of stepping into this ultra crowded space and low return type of existing properties. We like hyper returns. We like to offer our investors high. When we find something good, which is the one that we're evaluating now, that if we're able to offer investors 18, 19, 21% a year, we get interested. And on top of it, we have those extras. But the opportunity zones are very, very interesting, because if you're holding the asset, right, for 10 years, I know most of our investors, we specialize in short term, right? 3 years, 3.5 years, 4 years, 2.5 years, try to hyper returns. But think about it, if you hold the asset for such a long period of time, or a period of 10 years, and you sell it, and the asset is in an opportunity zone, then what's the tax as, Kevin?
I can't remember the rules, but I believe a lot of the taxes get wiped away and all.
It's wiped entirely.
Completely wiped away.
It's zero. The tax is zero.
But now, but Joe, remember, the opportunity zone requires the use of capital gains funds, right? So you have to actually reinvest capital gains funds.
Yes.
One of the benefits of the opportunity funds and the opportunity zone investments was that 5-year or 7-year or 8-year deferral. That deferral is slowly getting chipped away. So, the big carrot in the opportunity zone now is really not the deferral till 2027. Because when I sell that investment, I'm still going to have to pay the tax in a couple of years, right? Maybe I think it might still be like a 5% haircut, but effectively you're paying the tax. The big carrot is, like you said, particularly you guys who are kind of in the development space, right? Because you can't just buy, right? You can't just buy an existing asset in an opportunity zone and say, well, it's an opportunity zone, we're done. That doesn't work, right? You got to reinvest. So you guys who are in the development space, if you found an asset in an opportunity zone and you held that for 10 years, that could be very, very meaningful.
Yes. Yeah. Very great. It's honestly, it's fascinating. It's a lot of creativity around the structure of tax. But again, you got to follow the rules. There's a lot of kind of like, a lot of structures. Some of them are smart, some of them are smarter. So it's been really fascinating. Andrew, any more questions from?
Yeah, we have a couple. We'll try to just be brief here so we can get to all of them. This can be any state in the U.S., right?
Yep.
Okay. Just a question. When is the best time and/or the date to include the depreciation for 2024 taxes? Is that relevant, or is that just when you're filing your tax returns?
I mean, what happens is the entity that owns the property would engage in the cost seg study, and then the benefits would roll up on the K1s. So you would include that on your, if this was done for 2024, that would be included on your 2024 tax returns. But that would be really determined at the entity level. not at the individual investor level.
Got it. Okay. And Armando, if you can join us, please. I'd like you to ask your question live. So I'm having a trouble describing it properly. But while you're getting ready for that, are there any strategies for non-depreciable assets? Is that a thing for real estate? Is there anything that doesn't depreciate? I guess,
Oh,
Jordy, I'm not fully understanding your question.
Land.
I mean, land doesn't depreciate.
Land doesn't depreciate. Okay. Is there any strategies for that?
I don't know of
Not really.
anything.
Okay.
There's
Jordy, maybe you can repose the question. But Armando, are you able to ask your question live?
Armando, you do have the ability to unmute yourself. There we go.
Oh, hey, how's it going? Yeah.
Good. How are you?
All right, sweet. Yeah, so my question is, when an LP invests and they're able to benefit from the depreciation, well, I'm guessing I'm asking about the accelerated depreciation. I get the two confused still. But
So
either way,
the 60% versus the 40%, right? Are you
yeah, the
asking?
60%. Yeah, how we're able to capture 60% this year, and then it's reducing down to 40% next year, just
Sure.
because that's what's going on right now in the market,
Yeah.
or whatever, however that was decided. But that
So is that based on
60%,
the year that you do the study or based on the year that you acquire the asset, Len?
Yeah, it's based on the year of acquisition. So for instance, if we bought an asset in 2022, right? And for whatever reason we didn't do the cost seg then, and and you guys woke up and said, "Hey, I just heard about this cost seg thing. Can we do it now in 2024?" We'd be able to, and we'd get the full 100% bonus depreciation from 2022 to 2024. There's something called the 481A adjustment, whatever. We don't have to get into the details, but you would be able to do that. So it's really based on the year of acquisition. So in that year of acquisition, you get to accelerate at this point 60% of whatever we identified in the cost seg study as personal property and land improvements. That's taken right off the bat year one, in this case 2024. Now I'm left with the rest of my depreciation, which will continue to depreciate, meaning I still have 40% left over in my 5 and 15-year asset bucket that will depreciate over 5 and 15 years, plus whatever's left over in my 27.5-year bucket, which is the building, that will also depreciate regularly. So if for whatever reason, let's say that for whatever reason we were supposed to acquire this in December, timing, whatever, right? Our loan doesn't come through, and we end up buying it in Q1 of 2025. Now all of a sudden we've lost some of the benefit of the bonus depreciation, because now we have to take bonus depreciation only at 40% instead of 60%. So we're losing that benefit.
Got it. Okay. And there's a question from an anonymous person. I think that also answers your question, right? So it's really based on the year of purchase. The sunsetting in the future is not relevant.
Correct.
Is not relevant for that.
Correct.
There's a question: can you invest gains in a family banking component and not be taxed as a gain? I'm not sure if you're able to answer that, Len or Kevin, or maybe that's a question for
Invest those
an
gains. I'm
accountant.
looking at a family banking component and not be taxed as a gain. Is that an opportunity zone question? I'm not entirely sure what that question is asking.
Okay.
What that question is.
Paul, feel free to email us after, and we can see if we can answer it, or it might be a question for your accountant. I think I hit everyone. I'm not sure. I saw a couple like either single families or 3-unit properties. It's really any property you can do this on, right? Any like a single family that's used as a rental, a 3-unit property used as a rental, like anything like that, right?
Yeah, I mean, we do cost seg on, it runs the gamut from, literally individual condos that are rented out to, properties such as this. I mean, so we've done cost seg on properties that someone bought for 500K, and we do properties on $100 million, $200 million assets.
Beautiful. Okay.
Just maybe Laura, can you put Len's contact? I'm sure some of our friends and investors here might want to contact Len directly outside of deals that they have or assets that they own and things like this. So definitely love to recommend it. Very great, very great. Any other questions, any other comments? Len, Kevin, before we move on to the next topic?
Yeah, I think just the one thing that I always I just want investors not to be confused of is that there's something called it's bonus depreciation, which is the amount that can be allocated to the to first year, which is that 60% or 40%. But there's also a number we just call percent depreciation or however you guys look at it, which is the percent of your investment. So in this case, if you're investing $100,000 and we're looking at about a 48%, that 48% is based on your investment amount. So a lot of people confuse and they say, okay, why am I not getting 60% depreciation this first year on my K1? And so the answer is there's a difference. One is at the project level. Bonus depreciation's the amount of depreciation that can actually be funneled down the first year to the investor group. And then with the investor, based on the amount of equity it's being put in and all, we calculate a percentage based on the actual investment amount, which oftentimes, if you're looking at investment like this, we might give you a range that says we anticipate your depreciation to be anywhere from 40 to 60% of your investment amount. So just want to make sure people don't get confused between bonus depreciation, which is a static number and all, and then the potential depreciation you'll actually receive on your K1.
Thank you for diving into that as well. So thank you again, Len. Pleasure having you. Kevin, always great to see you. Of course, stick around. We're going to move on to the next topic, which is a real slice of what we do looking into our portfolio. I think we have an asset here in Miami, also a multifamily that we just recently completed. Andrew, you want to jump into that?
Yeah, we'll go over this fairly quickly here. I realize it's almost 6 o'clock already. As many of you are aware, right? As part of this Glassdoor, we also do a little bit of a peek into the asset management. So as Joe mentioned, a project called Elevate in Dania Beach, Florida, 293 units, Class A multifamily rental. Just recently completed about 3 months ago. We got the certificate of occupancy. The Astor position here is preferred equity. So while the project costs due to COVID have gone up a little bit, we are unaffected by that, right? We have a priority position where our returns are unchanged. The project has been leasing up very, very well, averaging about $2,750 per month. They've already leased 106 units since starting pre-leasing, which was towards the end of June, early July. So about 25, 26 units per month, which is ahead of pace. Normally on a project like this, you'd expect maybe 20 units per month. So we're very happy so far with how the project has been going. It's like I said, finished with construction. There's still a little bit of fine tuning to the amenity spaces, which again, very interesting. Interesting that they're still doing so well on leasing, and they're really not even having the full amenity spaces available to the tenants. This is actually an investment that will be exiting soon. The project is nearly at a point that they will be refinancing and buying our position out. This is a 48-month investment, and we're nearing the end of that term. That's really all we had for this presentation. Joe, unless you wanted to say anything on this page, I did just want to mention something else briefly. But did you have any closing thoughts?
Well, a lot of our focus for those who are not that familiar with Astor, I know that we have a lot of our investors here on the call, and we love that. That's exactly why we've created Glassdoor, sort of like to give you a look as to what's going on behind the scene. How do we pay attention? What time we allocate when we get investments? We get a lot of investment requests. We say no to a lot of it, as you all know, but then some stand out to us, and we're giving you kind of like a look behind the scenes to our asset management side of the business and our underwriting side of the business and the origination side of it. And so, this is sort of like what's occupying our day today. And in the evenings, we go out and we network and we shake a lot of hands, a lot of your hands, investors, new investors, and so on. We're very, very passionate about what we do from inception. We got 36 different projects. This is a company that next year we're going to be celebrating 10 years. But the managers, myself and Andrew and Laura and Marika and others, our collective experience have gone over 60 years if you put kind of like stick everything together. I wanted to say that this deal that we've analyzed right now with all of you here is essentially what we call being highly considered, and we'll probably be able to make a determination over the next week, maybe 10 days. It has certainly piqued our interest. The concept and what we're seeing right now is we're about to exit a similar deal. So just notice what's happening. We're about to exit a 293 apartment building, Class A, gorgeous apartment building, sort of like in the submarkets of Miami, right? So we're kind of like, our fingers on the pulse as to how fast we're leasing, right? Because in the beginning, you start with performance, all Excels and ideas, and we hope so, and we studied enough to think that will happen. But then it's very different when it actually gets to be actualized. When we're actually tracking how on a weekly basis the renters are coming in, the demand starts pouring in, the rents that we're projecting, we're meeting them and exceeding them. And that's sort of like what translates itself to our other decisions, right? So the next deal that we're going to be discussing, possibly in the next few weeks, is going to be a ground up, other than the deal that we're discussing. It's going to be a ground up of 350 units, also with one of the largest developers here in South Florida. And we're so embedded into those markets at this point because we're either at a lease-up stage, at a stage of checking the market because we're looking to sell or we're looking to refinance. So just to understand how our fingers is always on the pulse and how much attention to details goes into each and every one of those projects. I really appreciate that everyone here took the time, and it's always fascinating to see how many people are joining us. We'll see. We'll talk again in the next several weeks. But Andrew, back to you.
Yeah, so I just wanted to close. As Paul asked a question, South Florida, Miami area has been resistant to some of the hurricanes that we've seen on other parts of Florida. So thankfully that's always obviously a risk, but it's been a bit resistant to seeing much of the impact of those. I did just want to ask Damon and Alex, I guess, Laura, if you wouldn't mind just putting them on the panels here. Many of you may be familiar with Alex already. If not, we'd like you to meet Damon as well. Damon was recently brought on board to assist in the investor relations component for Astor. Alex is a regular on many of these sessions and is leading our underwriting. We are blessed. Laura is blessed to be expecting twin boys in the next 2 to 3 weeks. So she will be obviously stepping away to deal with that and experience all the joy that brings and sleepless nights. But so Damon will be taking over those responsibilities in the meantime. Alex and myself will be assisting. So Laura's going to send out an email with some additional contact information next week. But please feel free to email all of us. We'll make sure to answer things in as timely a manner as we can. And we'll be wishing for all the best for Laura, and that she'll be back with us next year.
Thank you, Andrew. Much appreciated. You'll be in good hands with the team, and looking forward to transitioning back early next year.
Awesome. Very great. Thank you very much, everyone, and good luck, Laura. Sending you a lot of blessings, double blessings.
Yes.
Thank you so much, everyone. Thank you, as always, for joining us. I will share the full recording and I will share the full information of Len Berkowitz after for you to reach out. Please don't hesitate to reach us with any questions, as always. I'm wishing everybody a wonderful, wonderful evening.
You work hard for your money. It's time to make your money work just as hard for you.
will have a secure future if you were to use Astor.
Hi, my name is Raquel El Khadif, and I'm a realtor with Broker Nation Real Estate in South Florida.
Hi, my name is Elena. I'm originally from New York, now currently living in Miami.
First and foremost, I was looking for my investors for institutional level investment. And the beauty of Astor is that an investor can come in with relatively a small amount of money and still be part of a big project with high returns.
Over the years, I've had many experiences with investing. I've learned so much, and approximately 5 years ago, I ran into a company, Astor, and found that they completed my investment approach. They are so selective with their projects.
The returns that they project are always high, but the track record is even higher than that. So it's kind of an element of under-promising and over-delivering, which I liked, of course.
Just based on years of trial and error and other companies that I've invested with, that they are far superior to all the other options that I've tried.
And it gives me and the investors some peace of mind.
I like that with Astor, I can sit back and have my money working for me.
They attract seasoned developers.
Feel very safe and secure with my investments with them.
I fell in love with them.
And I only use them now for my investments.
You guys made us feel like we're part of the family, and I thank you for that.